Under capital investment up to sell, next we are going to see net cash flow. Under the net cash flow, equal to, you have the formula, operating cash flow divided by capital cash flow. Net profit and net cash flow. Under the net profit, it related to the earned less all related cost profit related to the cash inflow, that is operating plus capital less related cash outflow, open a bracket, operating plus capital not including depreciation, that is equal to the net cash inflow. Accounting rate of return, that is ARR, the accounting rate of return method calculate the estimated overall profit or loss on an investment project and relates that profit to the amount of capital invested to the period for which it is required. A business will have required minimum rate of return for any business. This is related to the cost of capital of a business. If an investment yield a return greater than the cost of capital, then the investment would be considered suitable and profitable. The accounting rate of return is an average that is going to calculate by expressing the average annual rate of return under the percentage of average value of the investment. Average accounting rate of return equal to average annual profit divided by average investment. Average annual profit, that is total project profit after depreciation and before interest, tax and dividend divided by the estimated life of the project. Average investment, initial investment plus value of investment at project end dividend by 2. For example, Newport Leisure Park Limited is considering investing 1,35,000 in a new film ride. The ride has been estimated life of 6 years. At the end, which it is estimated it will be sold for rupees 10,000. The following cash flow and profit have been estimated. So they are given year and the profit calculation, average annual profit, average investment, average annual return. Next, accept or reject criteria for ARR method. Accept the project, reject the project. Project ARR greater than the minimum required return. Reject. Project ARR less than the minimum required return. Advantages of average rate of return. It takes account of the overall profitability of the project. It is a simple to understand and easy to use. Its end result is expressed as a percentage, allowing project of differing size to be compared. Disadvantages. It is based on accounting project rather than cash flow, and ARR, average rate of return, does not take into the account the timing of cash flow. The average rate of return does not take into an account the time value of money. It does not take into an account the cost of waiting the recoup of the investment. Its average rate of return takes no account of the size of the initial investment. The payback method. This method of investment appraisal simply asks the question, how long before I get my money back? How quickly will the cash flow arising from the project exactly equal the amount of the investment? It is a simple method widely used in industry, and it is based on the management concern to be reimbursed on the initial outlay as soon as possible. It is not considered with overall profitability under the level of profitability. Example is given, the same year net profit cash flow. So the formula is given, cash required to pay back divided by total net cash flow for the period. So here you are going to calculate into month 12. accept the project and reject the project. Payback period is less than the required by investors. It is a greater than the required by investors. Advantages: it's a simple to understand and apply. It promotes a policy of caution in investment. Thank you.